we are diving into the company for whom going bankrupt should be an extremely hard job. They have to work mischievously to go into excess debt, which would later result in bankruptcy. See, we all know the market cap is the company's total value. Then, upon entering the company, we are looking for debt levels that are one tenth of its market cap. How is it going to help us? See, we are already buying companies that are available at lower valuations than the rest of the market. Adding on to this, we are starting accumulation phase when they go below 40% from their all-time high. Once we start with a lower debt variable, that is one tenth of the market cap, it just gives us enough margin of safety to sustain through any kind of a depression cycle. See, we are buying into the companies which have a certain kind of demand in the future. So, the orders for the company will surely be lined up once our shop is opened up. The company is making at least 25% or beyond on their invested capital are my favorites. So, see, the only thing that could destroy us is if our company goes into excess of debt and suddenly it could not repay it. Best part is these things don't happen suddenly. So, how could this happen? Let's figure out our own wealth destruction. How are we going to lose our wealth? See, I have invested almost 8 lakh rupees, close to 8 lakh rupees in Phantom FX. Let's do an experiment and how can Phantom FX destroy my wealth? See, the company's current market capitalization is 275 crores. The debt for the company have climbed up to 45 crore. So we all know market cap 275, debt 45. So what do these debt levels indicate us? See, after the destructive downfall of almost 65% from its all-time high, the current debt levels are still below 20% of its total market capitalization. Once it was above 600, or I think above 600 rupees per share, now it is available at 202, 203. The company is in a growing sector with huge demand coming in, similar to the IT boom of 1995 2000. See, first of all, you need to know that in India, you are able to get the VFX creators at almost 1/8 of a salary in US. The company accumulated a net profit of 24 crore in 2023-24. The revenue growth is expected to be 15% plus for 2024-2025. Let's presume something bad will happen. Even if our company sustained to deliver only 24 crore that it delivered past year, then in next 2 years it will be able to repay its debt of 45 crore, which keeps us in quite comfortable position. This is what peaceful investing is. Our company should have a self-sustainable growth rate, because even if the current demand for its product dries up, it still should be able to make some money out of the current working orders, or by entering into new segments. What kind of new segment? These are catalysts that my company can enter into. First of all, commercial advertisements. It entered in 2023-24 when writer strike came. Or it can still enter gaming industry and boost up its earnings. My only problem is with debt level rising up and our company being not able to repay its deeds. But if the management is able to expand into new territories without endangering the balance sheet, then after a decade long investment, but we have to wait. I mostly presume that I'm going to wait a decade. After a decade long investment, we might be looking at a company that would easily jump up to generate a revenue of 1,000 crore plus with lowest possible debt. So, in our peaceful approach, we look for companies that are able to sustain through tough times. This could only happen if the balance sheet is in control and the company is working in a sector with good demand in the future. Thank you for watching. Please don't forget to subscribe. Bye bye.